Financials don't have to be scary. But you will need a basic understanding of some key financials in order to better run your business. Creating products, determining sales opportunities, and building a promotional strategy can be the fun parts of owning a business. But you also need to have the financial knowledge to make it work. Knowing what the income statement, cash flow, and balance sheet means and does will help you better communicate with your accountant. The income statement is a statement of your financial performance within a given time period, usually your fiscal year. It will show your revenue or expenses, whether you've made a profit or loss.
An income statement is a summary of business financial performance over a particular period of time. It includes all revenues and expenses of the business for that particular period, but does not include any changes in cash, asset acquisition, or changes in debt or equity. In Canada, at a minimum, every business, regardless of the type of entity, needs to use an income statement as the starting point to determine taxes payable. Beyond that, you need to use it to measure the effectiveness of the business during the measurement period. For example, a projected income statement can be used as a budget, and the actual income statement can be used to compare actual results against the budget for planned and anticipated results. In order to create an income statement, you need the total of transactions during the desired period in terms of revenues earned and expenses incurred. These should be broken down into the following major categories and ordered the same. Revenue from sales activities of the business. Cost of sales, which includes all variable costs of the business. General and administrative expenses, which includes all the fixed costs of the business. Other revenues and expenses, which are other items that are not generated by the business activities of the enterprise. Income taxes, estimated or actual on the income of the business. Depending on the nature of your business, you may have some or all of those categories. For example, a service industry business may not have any expenses as a cost of sale, but a manufacturing business would have that as a major item. Revenues are the increase in assets from the provision of goods, services, or investment income. The increase in assets could be cash, receivables, or the receipt of a physical good or service from a barter transaction. Cost of sales are the variable expenses of the business. Variable refers to the amount of the cost changing directly with the level of sales. For example, this could include materials, direct labor, and freight that is used in the manufacturing process. These costs will increase if the amount of goods manufactured increases. Gross margin is the net income prior to administrative expenses resulting directly from the sales revenues and direct variable costs. It is also known as profit margin. General and administrative expenses refer to the fixed costs of the entity. A simple way to think of them are the expenses that you would still pay to keep the doors open even if you didn't make a single sale. Amortization and depreciation are interchangeable terms to describe a decrease in value of a long-term asset. The amount of amortization during the current period depends on the cost, estimated useful life, and salvageable value. Other revenues and expenses are items that do not result from the business activities of the entity. These could include income from investments, gains or losses from sale of assets, settlement costs from a lawsuit, etc. The income statement ties directly into the balance sheet by affecting equity, specifically retained earnings. The retained earnings change to the same amount as net income or loss for the period. The income statement is usually the starting point for the cash flow statement. Non-cash items such as amortization are removed. Sales and expenses where cash didn't change hands during the period are also removed. Cash received or paid from sales and expenses of prior periods are included. An income statement cannot tell you how efficient you were in converting your activity into cash in the bank. That's what a cash flow statement is for. It is very possible to have a company that looks healthy on the income statement, but actually has trouble collecting cash and struggles with debt. Conversely, a company with lots of capital assets may not look healthy on the income statement because of high amortization, but has very good cash collection. An income statement also can't tell you what resources you have at a point in time. That's what the balance sheet is for. At a minimum, you need to update your income statement annually for tax purposes. If you want to manage with good business intelligence instead of luck, then you should keep it up to date as much as possible to make sure that you're comparing your actual results to your anticipated.
The basic equation on which an income statement is based on is revenues minus expenses equals net income. Let's use our Jen's Bakery case study once again to demonstrate a basic understanding of the income statement. The top of the income statement has a very specific format. The company name goes on the first line. The title of the sheet, in this case income statement, comes next. The third line is very specific as well. The wording should be for the day, month, year, ending on the date that represents the end of the period you are reporting on. In this case, it's Jen's fiscal year ending on December 31st, 2015. Now let's take a look at the rest of the income statement. The first part is revenues, everything that your business earns and the sources of those earnings. In Jen's case, she generates revenues from the products that she sells in her bakery. Jen also generates revenues by renting out a party room. Note that we use the right column to record her revenues or items that we consider profits. There is a cost to the sales that Jen makes in her bakery. This is recorded on this line. Note that this amount is recorded in the left column and is considered a loss for Jen's business. At this point, we can calculate Jen's total gross profit or gross revenues. Again, this is recorded in the right column. The second part of the income statement is expenses. These are all the costs that Jen's Bakery has to pay for in order to do business. In Jen's case, she has the following expenses: wages that she pays to one part-time employee, rent that she pays to the landlord for the space her bakery is in, utilities, cell phone and internet expenses, advertising expenses, and depreciation. Jen's equipment depreciates annually. That depreciation is considered a loss to her business. At this point, we are able to calculate Jen's earnings before tax, or EBT. The next line represents the taxes that she must pay on her earnings. We are now ready for the third and final part of the income statement, the net income. Revenues minus expenses equals net income. This is an oversimplified example of an income statement, but it gives a good sense of the main parts of this valuable financial tool.
We pause here in Financial Statements 101. Your call to action is to review the last 3 financial videos. This will put you in the right headspace to tackle the last video in our series. Financial Statements 101, Part B.